Hello. I wanted to make this quick video, pretty much just briefly going over the different types of whole life insurance. I know previously I made another video talking about term and whole life. Lately, I've been getting a lot of requests for whole life insurance, but there are different categories in that, so I wanted to kind of go over them briefly. I'm here picking up my daughter, so I don't have much time, but I wanted to go ahead and make that. So whole life insurance, pretty much what that means is that you're getting a policy that's guaranteed to pay out, if you pass away. It doesn't expire. It's going to be active as long as you make the payments on it and don't, it's called overloan, when you borrow, so much against your policy that there's nothing left to keep the policy going. So that's whole life insurance. Now there's different types of coverage length. Sometimes you can get a policy, especially for younger children, a whole life policy that's paid up in 10 years, 20 years, or any time in between. There are also whole life policies where you only pay one time. So those obviously would be like a lump sum payment. I know I have some. The minimum is $5,000 for the minimum lump sum payment. But yeah, there are those. So if you're older, obviously it's going to be more. And then you have your paid up policies in 10 years. That's also very popular among children, because when a parent gets a policy, you don't want to be paying something for your child forever. You just kind of want to have it while they're under your care. So that's a really good plan to have. Another reason why I like those for children, the 10 and the 20 pay, is because 1, you pay it while they're under your care. 2, it keeps building cash value even after you're done paying for the policy. So that means that when the child is an adult and they need money, they can actually borrow from that one policy that you've had on them all these years, and they can learn how to borrow and pay themselves back without it having to affect their credit. So that's a really good tool to have. Now, the other types of whole life policies are, most commonly, they're fixed. So once you get the set amount of insurance, it's set. So if you get a $25,000 policy, it's set at $25,000. It won't grow. It's set there. The benefits of that is that your insurance is never going to go down, and your payment's going to be fixed as well. And those also, again, whole life policies have cash value. Sorry, I lost my train of thought really quick. So for older people, yeah, that's what you want to get. Now let's go to types of coverage. You have level coverage. That means, again, how I said, it doesn't change. Your insurance is pretty much set. Then you have graded insurance. That insurance is whole life insurance for people that are not in the greatest of health. So how those work is the first year, the most common one of types of graded insurance is the first year they're covered for pretty much just the premiums and 10% on top of that. The most common grade that I've seen is 2 years, and then on the 3rd year they're fully covered. So if somebody is covered under that plan and they die on the 23rd month, just shy of the 2 years of being complete, pretty much they're not going to get the insurance amount. They're just going to get a full refund plus 10% on top of that. So that's a really good option if you have someone that is sick and cannot get insurance. But it's also very important to check what type of insurance they have, because I've had a lot of people that think they're fully covered and they're in good health, but for whatever reason the agent gave them a graded policy just because it was easy to sell. So those policies typically are made for people that have like dialysis, have had cancer in the past, have had complications with diabetes, that have amputations, things like that, where it makes it very hard for them to qualify for standard insurance. So you want to make sure that you look at what kind of policies, your mainly seniors have. Another thing that's also available, it's called whole life insurance with dividends. Those are really good because they participate with a company. So if the company does very well, they actually deposit and certificates of insurance. So your insurance gradually grows, but your payment is fixed. So that's a really good benefit. I really like that also for healthy seniors, because they don't have to keep upping their insurance, as the years go on. All they do is keep it for long enough. Hopefully the company does well, and once that certificate is deposited into there as a dividend, it will not be taken back. So let's just say the company doesn't perform well 10 years down the road, but their policy has earned, let's just say $5,000 in dividends. It's not going to go back down. Their new policy is their base plus whatever's been deposited on top. So that's really good. And again, like I said, their payments are fixed. I think my daughter's out. So pretty much that's the biggest thing to worry, to look out for, is if you have a level whole life policy or if you have a graded whole life policy. Again, you also have the option to get a permanent policy, but that you pay up in 10 years or 20 years. Those are the two most common paid up options. Okay, let me know if you have any questions. You can actually comment on this video if you do, and I will do another video later on to answer any questions you guys might have. But I hope you enjoyed it, and yeah, thank you.